Good morning. Welcome to this, our Citadel annual client presentation. We have now presented this presentation at more than 20 venues to more than 3,000 of our clients. But demand continues and time is running out for the year, so we've decided to bring this to you via this channel, this live webcast. And now we hope you can enjoy this wherever you are, whenever it suits you. And on that front, may I ask you that afterwards, that you please complete the short survey that we have there, because that'll assist us in continually improving on the product and delivering exactly what you require from this channel. Also, you'll have the ability via this channel, on your bottom right-hand corner, where the question mark is, to post questions anytime during the presentation, and we'll get to that at the end of the presentation. Good morning again. My name is George Herman, and I'm coming to you from our Sandton office in South Africa. It is our pleasure to spend time with you this morning. At Citadel, we take the management of your money very seriously. We care for the funds of more than 8,000 families, more than 55 billion rand in assets, and that is what we do every single day. Our theme for this year is leaving a legacy, and we understand the privilege and the responsibility that we have in managing your assets in order for you to leave your legacy. As introduction to this presentation, the following video.
What will your legacy be? Well, it depends on what you do with your time. Your decades, your years, your months, your minutes and moments. Because a legacy isn't a grand design imposed suddenly one day. It's a collection of thoughts, habits and actions accumulated over a lifetime. We will all leave a legacy. We hope good. We hope long-lasting. But it starts with our minutes, our moments. What will your legacy be?
Just as you build the legacy of your life, 1 minute, 1 moment at a time, for us to deliver investment success is the exact same process. Investment success doesn't happen overnight. It doesn't happen with one magnificent trade. Investment success is a diligent process that happens every single day, 365 days a year, every year of our lives. And that is what we are committed to do. Now, in order to manage your investments, we need to understand the global economy and where the world is going. Yes, these economic presentations are always very boring, so we'll go through it pretty rapidly, but it is just to sketch the scene of how we see the world developing, where the opportunities are and where the risks are. So getting to the global economic overview, plain and simple, over the last decade, we have seen the global economy expanding post the 2007-2008 global financial crisis. As you can see in this slide of the G7 countries, you see that they've all expanded over the last decade. The US is now growing its lead over the other economies. But the more important thing is that the momentum of this economic expansion is slowing down. This is the leading indicator for the G7 countries, and it's quite clear that the economy has lost some of its momentum. And here arises our most important question in managing your investments is, are we going into another recession? This is the longest expansion we've now experienced in history for the US economy to grow for 10 consecutive years. So all the warning bells are ringing. Now, global sentiment, and specifically the sentiment in the US, has also been dwindling over the last while. And you may ask, why is that? Well, you're not going to really like the answer, because the CEO confidence index has really plummeted since Mr. Trump came to power. Yes, I know a lot of you love Mr. Trump, and I do too, because he gets things done. The only problem with Mr. Trump is he has no regard for decorum. He just trashes everybody in sight. So this is his tweet he sends out at midnight, and hence why I sleep like a baby, waking up every 2 hours crying, is that, he says that we've been at this war for a long time and we've been losing it, etc., etc., and hence he goes into a tariff war with China. And we'll get back to that comment. Because right now, we have this situation where Mr. Trump thinks he's dishing out pain to China, but he forgets that they play the long game. They dish the exact same thing back at him. And we have the situation now that the two largest economies in the world are waging economic war. And as the old saying goes, when elephants fight, it's the grass that dies. And so for us in emerging markets, this is a super important setting for the global universe. And when we get news every day about Mr. Trump this or some Chinese official says that, we don't care about it. That is noise. The fact of the matter is the two largest economies in the world are at war with each other. And we will remain very cautious on our investment setting for as long as that is the case. Now, Mr. Trump didn't keep those comments only to China. He even trashed his own central banker. Poor Mr. Jerome Powell had hardly arrived in his new job as the Fed chairman, and Mr. Trump was all over him. And it seems like Mr. Trump may have had a card up his sleeve, but let's look at the evidence. The reality is that in December of 2018, when the Fed was still hiking the interest rates, and during that hike announcement at the post-conference, Mr. Powell explained to us why the Fed was more than likely going to hike twice more going into 2019. And hence we had risk markets selling off aggressively during December of 2018. Then we arrive in January of 2019, and at that same press conference, Mr. Powell suddenly said, no, we're not going to move rates and we'll be patient. Phew, that was a quick turnaround. And then the European Central Bank doesn't waste any time. They start adding stimulus to their economy and they cut their rates as well. So now suddenly the Fed finds itself in a predicament with the rest of the world cutting interest rates and they still promising that they're going to hike rates. That won't make sense. And so in June, they for the first time indicate they might possibly cut the interest rates. And come July, they actually cut the interest rate. After in December, they told us they're going to hike it. That is a monumental turnaround. Why did the Fed make such an aggressive U-turn? Was it just because Mr. Trump was all over Mr. Powell? No, it wasn't. It was because the economy in the US had been slowing down much faster than the Fed anticipated at the end of 2018. And suddenly they had to support this economy by starting to cut interest rates. Now that is a major turnaround in the fortunes and the outlook for the world. But despite that, the risk markets in 2019 has responded spectacularly. Now, the Fed didn't stop there. They cut rates twice more after that again. So they've cut rates 3 times already in 2019. And the market's pricing in that there's a chance that they might cut even more. And so it's no surprise to you that the S&P index is up more than 20% this year. But it's not only the S&P index that's higher, also the defensive assets, US Treasuries, which are seen as safe haven assets, and gold, which is also a safe haven assets, all of those, their prices have increased. So this is a peculiar place we find ourselves where growth assets are running hard because of the backing of central bank and accommodative monetary policy. But we also have defensive assets running hard because the world is scared because of this slowdown and geopolitical uncertainty. So can you see that many assets in the world now are overpriced, expensive, and at a very, very risky place. China didn't wait too long before they came to the party as well, because their economy was also slowing down and also taking pain down due to this trade war. And so they started adding stimulus to their economy as well. But they have acknowledged that they are happy if the Chinese growth rate cools down from 6.5 to 5.5. Yes, Mr. Ramaphosa, 5.5. How's that? They consider that a slowdown. Wow, amazing. Any case, the the Chinese economy is slowing down somewhat on its growth path. But, the Chinese play a 200-year game. They're not playing the game just for the next 3 months, as Mr. Trump is, to avoid impeachment and try and get re-elected again. And so you can see in the time of history, Mr. Trump's part of it is a short blip in time. And as Mr. Churchill suggests, we should look further back. And the better we understand the history, the better the likelihood that we'll understand how the future evolves. We agree with that. Because understanding economics and understanding financial markets is not a science. There's no textbook that has got negative interest rates in it. It never existed before. How is that going to impact? What will the effect be and how will it be unwound? We don't know. Understanding economics and understanding financial markets is about understanding people. It's understanding societies. It's understanding how people interact facing similar circumstances. When a person sees a lion, they react the exact same. Doesn't matter whether it's now, 100 years ago, or 100 years from now. And when society is faced with a specific economic situation, they will react the same. Now, negative interest rates is a very unique phenomenon because when it becomes negative at first, people go, woohoo, this is fantastic, we get money for free. But when central banks start cutting negative interest rates even further, societies go, whoa, there must be something wrong. Why is the central bank so scared? Maybe we should save our money and not spend it. And then it leads to even slower growth. So can you see, textbooks never foresaw how negative interest rates could not work in the way that we understood the normal economic setup. So Mr. Churchill's advice is very prescient. So when we look at the most commonly used indicator to try and predict a recession, we look at the shape of the yield curve. It is the long interest rate over the short interest rate. Normal economic theory would suggest that long interest rates should always be higher than short-term interest rates. But when the market gets scared about the future, long-term interest rates decline and you find a few rare occurrences in history where they actually go below short-term interest rates. That is on that line, every time the orange line goes below zero is what we refer to as the inversion of the yield curve. Never before, the grey portions on that graph is recessionary periods. So never before in history have we had a recession where the yield curve has not inverted prior to that recession. And so the logic now says that if the yield curve inverts, we'll have a recession. We don't think that that logic holds, but it is a unique phenomenon, and hence when this happened, the media went wild about the yield curve is inverted and hence a recession is coming. We don't think it's that simple, plain and simple. We've had quantitative easing, and central banks have been purchasing long-dated paper. And as they've been purchasing long-dated paper, you've had an additional buy in that side of the market, which you've never had before in history. So we don't think that the mechanism of transmission of this economic indicator into the real economy is the same that it was in the past. But we are arguing a little bit with Mr. Churchill here, but we have to be open-minded as we go into this. Now, another important factor is that the makeup of global growth is changing. Just look at this unique graph which shows the amount of dollars that is added to the economy by all these various areas, and this is for 2019 GDP growth. So yes, the US is the largest economy in the world, but we know they're not growing the fastest. But we're not only measuring the speed of growth, because a small entity can grow very fast, but here we're talking about large entities. So let's look at the absolute quantum. This is the amount of dollars added to those economies by this year's growth. And you will see that China's growth alone is 50% more than that of the US. And if you take that whole Asian bloc, it is significantly more. It is more than double that of the US. So if you don't believe any of the research that suggests that China will become bigger than the US, there's your fact. It's an absolute given they will become bigger. And China is playing a 200-year game, not just 4-year election cycle game, so it's very, very different. This phenomenon will continue, and it is an important part of our investment thinking. This forms and informs a lot of our thematic thinking in various industries, countries, regions, products. I'll get back to that in a moment. So enough of that about the economics of the globe. In summary, then, that the U-turn that the global central banks, specifically the Fed, made in 2019 by switching from hiking rates to cutting interest rates has probably prolonged and pushed out the inevitable recession somewhere deeper, maybe into 2021, and has thus reduced the possibility of a major breakdown in the markets for now, although many risks still continue. As we indicate there, geopolitical risks still remain. And so the tensions that exist between China and the US now is super important. How that plays out into next year's election year in the US will be exceptionally important, and we will stay close to that. So that makes it up for the global economy. Let's have a quick look at the South African economy. And if you wanted to build a legacy, this is probably the most legendary person that South Africa has ever delivered, so nothing further needs to be said about that. So what we're looking at here is the annual growth rate of South Africa over the last 70-odd years. Then we added to that the 3-year average of that growth rate. We then add to that population growth. And you'll see we've had a scenario in economic growth that from that 2007-2008 recessionary period the world experienced, we did not recover. Our growth kept on going down, whereas the rest of the world recovered, as I showed you in the very first slide. And this has been the bifurcation of South Africa breaking away from the global economy, and not in a good way. So I'm going to remove the annual growth just to clean up that graph a bit, because we want to make another point here. That South Africa has been here before. That level of growth that we're seeing there, we've been here. We were here in the 80s, we were there in the 70s, we were here in the early 90s. We had these periods of very low growth. It's not the end of the world. What is important is whenever 3-year average, let's call it cyclical, medium-term growth subsides below population growth, that forces a situation when the populace starts rising up. That is literally the starting button for populist politics. That is when change takes place. And you can literally mark South Africa's political change events on this graph. This phenomenon leads to change. So yes, we find a lot of negative sentiment out there in South Africa right now. As I said, we've just taken this presentation series all around the country. We have never experienced such a negative sentiment amongst the average South African and amongst investors. But we think it's maybe overreached itself. It's becoming self-enforcing and is not supported by all the facts. Because as long as these 4 gentlemen are in their post, by the way, this is that economic situation of economic growth being below population growth leads to change. Well, the change we had is these 4 gentlemen in their current positions. As long as they are in their positions, you cannot be negative about South Africa. Mr. Gordhan must be the absolute perfect example of what a public servant should be. Hardworking, honest, straightforward, dedicated. I can't believe I'm saying the sentence in the same sentence as public servant. But in any case, that is Mr. Gordhan. Mr. Kganyago has defended the Reserve Bank and has been an exceptional central banker. He's been disciplined, he's been quite hawkish, he's been totally independent from influence from politics, and so much so he's now the chairman of the Global Board of Central Bankers. Mr. Kganyago is a globally respected central banker. Mr. Mboweni, he's got the toughest job in the country right now. He's the foreman for the president. He's saying all the things that must be said and should be said, which the poor president can't say because he has to pander to different political scenarios. Mr. Mboweni is getting all the important issues into the public sphere for debate and bringing it up so that everybody can have input in it. He interacts with the private sector. Wow, how's that, government? How fantastic is that you have the opportunity on a regular basis to interact with the Minister of Finance. And he takes that advice in. Mr. Ramaphosa, we don't have to say much about him. He's an ultimate statesman, but he has the toughest job on the planet, serving two very different agendas, going two very different ways, and I don't have to tell you anything about that. I'm no political analyst, and I'll get back to that point in a moment. What we want to bring across is Mr. Gary Player's advice. Your success is often determined by your thinking, and we have to watch out as South Africans that we don't fall in this trap of perpetual negative thinking. Now I'm going to say, yeah, Georgie Porgy, you're not here to sing Kumbaya. Yes, you're right. We're investment analysts, but we have to remain objective. We cannot get sucked into this cycle of just negative thinking. We analyze the facts. Unfortunately, the negative facts are very hard. Unemployment in South Africa is the scourge of this country. We need economic growth. We need job creation. How are you going to tell that young man to be positive? You're not going to get that young man positive. That young man needed to be educated better, and the education standard need to be of a nature that he is globally competitive, because we compete with other emerging markets. Just lowering the matric pass rate doesn't solve the problem further down the line. Our biggest problem, the elephant in the room, literally for South Africa, is the land redistribution policy. This needs to be addressed. This, along with the mining issue, we need policy certainty before South Africa can move forward from an investment perspective, from a social perspective. This is the issue. The governing party for the last 25 years have not made much headway in this, and we need this resolved before we can go forward. I don't have to tell you about the problem our state-owned enterprises are in and the risk that Eskom poses to the country financially. We're all well aware of that, and we've invested that way for 3 years already. The financial markets, the exact opposite to the yield curve shape I showed you earlier for the US, where the yield curve is inverted, long-term interest rates below short ones. Look what the market is saying to South Africa. The exact opposite. It is saying, hey, South Africa, wake up. You're going to pay a lot more for debt in the future. And our yield curve has become a lot steeper, meaning that government will pay more for debt in future. And taking on more debt in an environment like that is a very unhealthy and tough situation. Speaking about more debt, we had so many comments that the medium-term budget was so horrendous and ugly. It wasn't horrendous and ugly. It was the first honest, truthful budget ever. For the last couple of years, the government has been polyfilling over the lies. Look in February, the bottom line on that graph. That was the debt to GDP trajectory they put out in February. They didn't want to be downgraded by Moody's, so they said that's how it's going to pan out in future. We'll have fiscal balance in future. We won't go over 60% because that's the line in the sand for being investment grade. But that was based on absolute ludicrous assumptions. Now Mr. Mboweni comes out and for the first time, truthfully honest, brutally honest, put the facts on the table. Not even bailing out Eskom takes you to that second line where our debt goes to 75% of GDP and there's no sign of it improving and balancing out. Then you bail out Eskom and you get to 80% debt of GDP. Now, quite clearly, we have now gone way beyond investment status and deep into sub-investment grade. Moody's, hello, wake up. We have to wait till next February's budget for Moody's to wake up. The reality is we will be downgraded, and even if they're still asleep and they don't downgrade us, the market has priced some of our assets for downgrade, all except the rand, because the rand will still have to reflect the flows. But let me get my blood pressure down on that one. Here's the good news. Mr. Ramaphosa understands that this country needs investment to grow. So his first thing he did is he went to go and pitch to foreign investors to get investment. And here what we express is annual GDP growth, that's the grey bar, and fixed foreign direct investment in the orange bars, and you can see how that trend is turning around. And just this very week, he has that exact same investment in Durban again. So we can add the 2019 bar to that now. More than 300 billion of pledges have been made. Yes, some of them are rubbish because it's people who would have done it anyhow, but they like the show, blah, 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 they arrive there. But a lot of foreign investors get drawn to that because they can see the commitment of government and other private sector entities to the economy. And this is the best piece of news in the South African economy right now. Now, we touched on a whole bunch of political issues, and it's the worst thing in the world for an investment manager to get involved in politics, and so we try not to. But the reality is that politics, both in South Africa and abroad, has a huge impact on the markets, are very important in where the markets are now. And so we've enlisted the services of the Paternoster Group to assist us in that. They are a political advisory business and objective, but with thorough insights. And we take the inputs. We recently, or earlier this week, in fact, sent out their most recent report to all our clients. I would urge you to read all 10 pages of that. It is magnificent insight into the political dynamics of South Africa. I've summarized it there for you under the 10 points. But I think if you just pull it through, the fact of the matter is they feel that some bullishness are returning and they're referring to the country, not necessarily to the financial markets. And it is getting better. We just need one person in an orange jumpsuit and South African sentiment will jump through the roof, just like it did with our Springboks winning the World Cup. And so sentiment is a very fickle issue and politics has a major influence on that. And so the deeper understanding of that we get from the Paternoster Group, and they are not nearly as negative as the general sentiment that we experience in South Africa right now. That pulls through to the Rand. Here's the last 30 years of the Rand. That line you see through there is literally just the long-term generalized depreciation of the Rand. It comes from the real interest rate differential between the two countries and is an absolute economically sound principle that should happen. So that's kind of the normalized level. When it shoots out and depreciates a lot more during times of stress, it typically gets back to that level. So right now, the Rand is at neutral level. We don't see it as majorly overbought or oversold or overvalued or undervalued. Some people very optimistic see this level see the Rand going down to 12.50. You have to have the perfect storm of a bunch of good things to happen. Personally, I really don't see that happening. On the other hand, you have a lot of scaremongering that the Rand's going way north. Also, that suggests that that's not necessarily the case. The Rand is well balanced right now. Yes, the downgrade eventually by Moody's will cause some shock, but that'll be a great time to buy some assets very cheaply. So to summarize South Africa and the issues that we have, one of the legends we have in South Africa is Zanele Situ. And if you don't know her, the first black lady to win a gold medal at the Paralympic Games, and she didn't stop there. She didn't only win one, she won two, despite her setbacks. And South Africa is facing that exact same scenario, and we have no excuse. We can go ahead. Yes, we have problems, but we've been here before. We have great leadership in place right now, but the talking must stop and the doing must start. And I think we all agree on that. So we're waiting for some clear crystallization of some issues from Mr. Ramaphosa, and I'm sure we can expect that as we go into the new year. Now, enough about the economic and political background. Let's get to some of the investment issues. We take some of our lessons from investment legends. And Mr. Dangote shows us in Africa, you have to be tenacious, from Africa rather, you have to be tenacious to be successful in business. That's true anywhere in the world. Mr. Miller reminds us that mathematics, certainly doesn't belong in the markets, and that what we do is not a science. It is as much of an art as a science. And Mr. Bogle, magnificent lesson to all us youngsters. Whenever there are many solutions on the table, take the simple one. And so we often try to find the most simple solution to our problems rather than just trying to make it complicated. Citadel has built a legacy on investment returns, and on not only investment returns, but on wealth care in its broader sense. I'm only talking about investment returns today, but our business is so much more and so much bigger on the entire range of wealth care solutions. In terms of investments, we base our investments on 4 pillars or 4 core philosophies, and I quickly want to highlight those to you. The first one is that the future is uncertain and will surprise. People often say, you just use that as an excuse when you're wrong. No. That's not what it's about. What it is about not trying to be so smart and predict exactly where the world's going to go, but rather entertain all the scenarios and make sure that your investment process can handle any one of those outcomes and that your portfolios are robust through various different scenarios, not just trying to pick one, because otherwise it becomes a binary bet situation, and that is not investing. So this is very important in our philosophy of investment. Nobody predicted Lehman's falling over in 2007, and that had amazing ramifications. The second principle of our investment philosophy is that diversification is super important because it adds to returns, but it also reduces risk immensely, and hence we put a lot of emphasis on diversification. I want to show you that in practice. Here you have a graph. It's quite a busy graph. Sorry, it is small on some of your smaller screens, but take my word for this, you'll see it pan out. You have the JSE All Share Index over the last 25 years in the black bars. You have US bonds expressed in rands for you as a South African investor over that same period. Its annual returns in orange. The JSE delivered 15% return over that period with a standard deviation of 19. The bonds delivered 12 with a standard deviation very similar at 18.5. What is unique is the characteristic that they perform at different times. And you'll see that whenever the JSE battles, those bonds in rand perform very well. Well, that's because when the world gets scared and they sell risky assets, they go and buy US treasuries, and hence you find that phenomenon. But look now, when you create a portfolio that consists of 50% of just those two assets, you now get a portfolio that delivers you 14%, just a smidgen less than the JSE. But look what happens to the risk number. It drops to 12%, a significant reduction. That is the basis of how diversification works. So we attempt at asset class level to diversify, but even at asset level, we try and diversify. Let me show you how. We picked that theme of the Eastern world growing faster than the Western world, which I showed you earlier. That theme leads to urbanization, a world that is more focused on electronics, a world that is living greener, a world that is going towards electrical powered rather than fossil fuel powered. Those themes filter through and you end up buying a company, Starbucks. Why is that? Well, Starbucks will be opening a new store in China every 15 hours for the next 3 years. Already one of the world's largest consumer companies, it'll more than double their turnover in the next 3 years. What a phenomenal use of that whole story, that whole theme of urbanization. And so yes, there's some ESG issues which we have to take care of. Are the coffee sourced properly? Yes, we take care of all those things, I assure you. I don't want to beleaguer that at length right now. But that is a proper sign of how we implement the theme. But how do we diversify that theme? Well, here's a company that you all know, Anglo American. Anglo American, over the last couple of years, have reduced their unit costs by 26%. They halved their assets. They increased their production levels by 10% and doubled their productivity since 2012. It sounds like Eskom, doesn't it? No, it doesn't. The exact opposite. This is absolutely brilliant. This is what you look for in any business. But they also glean on the themes of a consumer world that's more electric and more green. Boom. So you end up buying a theme, but to diversify your bets, you end up buying a coffee company and a mine. You don't put all your money in one basket. That is the theme of diversification. The third pillar of our investment philosophy is being valuation sensitive. Plain and simple, be wary when you buy expensive stuff. You have to know what something's worth. So this analysis shows that over a 5-year rolling period, that low PE stocks deliver a higher return than high PE stocks. But you can't just buy low PE stocks because just like in real world, very often junk is also cheap. So you can't just buy cheap. Fact is, you have to be valuation sensitive. An important part of investment process, you have to know what the asset that you buy is worth day one. Now, a lot of noise and a lot of investment managers will talk to you about the individual sexy stories of equities, but the important thing is about asset allocation. And that is not only in our hands, it's also in your hands. And so you as Citadel clients would have seen this slide before, because your wealth planner and your wealth manager would have worked through this with you. We have very distinct distinctions between our portfolio, stable, prudent growth. And they give us very specific mandates to manage very specific return and volatility targets, each one of those buckets. Because that allows you and your financial manager to create an exact payoff profile on your investments that suits your life. And so if we stick to our mandates and deliver on all of those, it'll filter through to yours. And that asset allocation decision is the most important investment decision you will make. And so on this legend, we don't have to say a word. He wasn't so much of a legend 3 weeks ago. He's a worldwide legend right now. And so say welcome to South Africa's newest legend, I would say, but also to Citadel's newest brand ambassador and Citadel client, by the way. And so looking at some opportunities in the world when we highlight the relative attractiveness of all the various asset classes around the globe, you'll see many of them are a touch below neutral, marked red, some red flickering lights there saying, watch out a little bit. And so we are very cautious at this point in time and rather pulling back, make sure we have some dry powder that when the world gets volatile, that we are able to access many of those distressed opportunities for long-term investment success. So in summary, the U-turn that central banks made has probably pushed out the recession quite a bit further. In South Africa, we have to be done talking and start doing. Preserving capital is our first priority right now, and we'll be doing that through diversification and working hard on our investment philosophy, making sure that our diversification is in place. We will manage the currency because a lot of volatility will come through that avenue into your portfolios, but we will manage that. But after we've done all of that, you need to do the part of following your disciplined financial plan in tune with your discussions with your financial manager, your wealth manager. And so that summarizes our investment presentation. And maybe not all of us will end up with as palpable a legacy as Mr. Christian Barnard there did. But as Archbishop Desmond Tutu quite clearly said that our humanity is bound together. And if you think that you are too small and that whatever you do is too little, it won't make a difference, try and sleep in a room with one mosquito in it. We've all had that experience. Something small can make an enormous difference, and so can you. The Citadel Philanthropy Foundation was specifically created to assist our client base to have a professional avenue of giving. We all want to give, but you don't want the money to be spilt, stolen, misappropriated, all the ugly words in South Africa. We have that specific process under control. Jean de Villiers has ran our Philanthropy Foundation now for a couple of years, and he has truly professionalized that into the leading entity of its kind in South Africa. To highlight to you and to show you is one of our most recent projects. At a little town called Onseepkans. Many of you probably never heard of it. Other side of Pofadder, northern border of South Africa with Namibia on the Orange River. Many years ago, a major flood just took away the whole town and all the farmers up and left behind a little community that was absolutely destitute. Government then came and said, well, there's nobody here, you've stayed here for centuries, why don't you take the land? And they created a situation where they gave 26 families a portion of land, and 6 family members had to sign for each piece to make sure that it stays, and essentially said to them, now it's your land. But there they landed up with land and nothing else. What you need is capital, intellectual property. And that's exactly how we partnered with an entity called Talmar, who focuses on community development. And so when I recently went on holiday and we were on our way to Botswana, we took some time and went and spent a day, my wife and I, in Onseepkans. And for ladies, you go for your shopping to Woolies. Well, now you have to drive 60 kilometers on a corrugated road to get to the metropolis of Pofadder. But in any case, so we covered all of that. You get to the town. The only way you know you're in the town is that the border post sign tells you you're in Onseepkans. Other than that, you wouldn't know it. I spent an entire day with Leon Taljaard, who runs Talmar, the whole project. He took me around and I met all the people, saw the pump station. This is for real. Money is getting applied properly. This is the dam they built, absolutely magnificent. And whilst we were still sitting having a braai at 8 o'clock in the evening, the workers all still going out in the field working. Why? Because it's their land. Makes a major difference. And I'd like to share with you the video we made of the project in Onseepkans.
In South Africa, there is opportunity. In a collaboration, there are unexpected solutions. In a desert, there is growth. At the edge of the Orange River, in the northern Cape town of Onseepkans, the Citadel Talmar Impact Foundation has embarked on its first project. The community's shared land is being used to grow grapes that are turned into raisins that end up on European shelves. Farming is never easy. But Talmar's community-based development expertise is world-class, and Citadel's financial know-how means that investor capital goes exactly where it needs to. Together, the team has helped to create an empowerment plan that is nothing short of revolutionary. It's not a charity, it's a business. It's not a designed for Instagram handout. It's a hands-dirty process made possible by expertise, sweat, and commitment. It's not a quick fix. It's a long-term journey that deals with some of South Africa's most powerful challenges: poverty, land, legacy. In just a few years, the results are clear. A raisin yield that has increased by more than 10 times year on year. Over 600 jobs in the making, and the chance for each household in Onseepkans to earn a living wage. This small town could be just the start of a conversation, of a change, of a movement. This is venture philanthropy. Let's grow.
We can all make a difference. It is absolutely our privilege and the greatest responsibility of our lives to assist in managing your wealth, in assisting you to leave your own legacy. Thank you very much, ladies and gentlemen. That concludes the formal presentation for today. As promised, I will now try and handle a couple of your questions that you sent through live during the session. And I remind you, please fill in the little survey afterwards, because we would like to serve you even better in future. So, let's get over to the questions. Climate crisis, global economy, food production, living conditions. Barry Kruger, what a tough question you boiled me with over on this one. Well, the reality is that we all agree that climate is an enormous issue. Food production is an enormous issue globally, and specifically for us in Africa, sub-Saharan Africa, it is super important. At Citadel, we don't tackle that specific issue in its own right, but climate change and food production are two important issues. Firstly, food production is an important part of the land distribution policy, and that is super important. We know that. And then climate change is part of the bigger picture, which is referred to as ESG, environmentally, social, and governance issues. And globally right now, one of the top 3 priorities for all asset management firms is to incorporate thorough ESG policies into their process. We are doing the same, and we hope that that at least will assist in that process. We have not done anything directly further than that. Maybe via our philanthropy projects there will be something more, but that is how we are going about that. Barry, please mail me if you would like any more information on that specific subject. So let's have a look at another one. What kind of positive spin-off can we expect from the Rugby World Cup win? There we go. Karen in Cape Town. You are spot on right. We highlighted that the negative sentiment in South Africa is probably one of the biggest inhibitors to growth. and preventing people to commit to the country, to capital, to projects, to growth. And we just need that sentiment to turn. As I joked, we needed somebody in an orange onesie to just make us all feel that the political wheels of process, that they are turning and working. But in that exact same vein, the Rugby Cup World Cup victory has just shown us what the United Nations can do, what we can do together, what a wonderful, talented, resourceful country we have. We often forget how many resources we have at our disposal. We are some of the largest and best and most important producers of many minerals around the world. This is a magnificent country. We just need solid legislation, we need solid policy, and this country will flourish, and all we need is a little bit of positive sentiment, and that will undoubtedly help. So I do believe that that is a positive. Ladies and gentlemen, that wraps up today's webcast. Thank you very much for the time you spent with us. We really appreciate that, and we see you soon. Bye-bye.